The average American household is carrying over $105,000 in debt right now. And the people telling you debt is the enemy? Many of them are dead broke. Meanwhile, the wealthiest people on the planet, the ones with private jets and portfolios worth more than small countries, are also in debt. Massive debt. On purpose. So which is it? Is debt the thing that ruins you or the thing that builds you? The answer is both. And until you understand the difference, you will never actually build wealth. You'll just survive paycheck to paycheck while quietly funding someone else's fortune. By the end of this video, you'll know exactly which side of that line you're standing on. Here's the part almost nobody explains clearly. Not all debt is the same animal. There's debt that takes money out of your pocket every single month, with nothing to show for it later. And there's debt that puts an asset in your hands, something that can pay you back over time, appreciate, or generate income. Economists have a simple shorthand for this: consumer debt versus productive debt. Consumer debt, credit cards, most car loans, buy now, pay later, disappears the moment you spend it. The dinner gets eaten, the shoes wear out, the balance stays. Productive debt is different. A mortgage on a property that appreciates. A loan that funds a business generating revenue. Even, for some people, a strategic loan against an investment portfolio. The debt is still real, but it's attached to something working for you in the background. Confusing these two categories is, without exaggeration, one of the most expensive mistakes a person can make with their financial life. Let's start with the trap, because it's the one swallowing the most people, right? Now, credit card interest rates currently average above 19%, among the highest. Borrowing costs available anywhere in consumer finance. Here's what that actually means in practice. A typical cardholder carrying around $6,500 in balance, paying only the minimum at roughly 19% APR, could remain in debt for over 14 years and pay back more in interest than the original balance itself. Read that again. Not a few months of inconvenience, over a decade, paying interest on top of interest for purchases that were forgotten months after they were made. And this isn't a fringe problem. Around 3 in 5 Americans carrying card balances have been in debt for at least a year, up sharply from just a couple years ago, and roughly a third of those have been stuck for 3 years or more. Total U.S. household debt has climbed to a record $18.8 trillion, with mortgage debt alone exceeding $13 trillion. This is the version of debt that gets sold to you as normal. It is normal. That's exactly the problem. Now flip to the other side of the ledger. Wealthy individuals and large companies routinely carry enormous debt loads, and they're not embarrassed about it. They're strategic about it. 3 things separate productive debt from consumer debt. First, the interest rate is low relative to what the borrowed money can earn. A mortgage at a few percent against a property, appreciating or producing rental income, isn't a burden, it's leverage. You're using someone else's capital to control an asset bigger than your cash alone could buy. Second, the debt is attached to something that generates cash flow or appreciates. This is the line that separates a wealth-building loan from a lifestyle loan. A loan for a rental property that pays rent every month is fundamentally different from a loan for a vacation that's over in a week. Third, and this is the one people miss, debt taken against. Assets is often used instead of selling those assets. Wealthy borrowers frequently take loans secured by investment portfolios or real estate rather than liquidating them, preserving the asset's growth and avoiding triggering taxes on a sale. The debt becomes a tool for accessing money without giving up the asset that's generating wealth in the first place. This is the entire difference in one sentence. Poor and middle-class debt usually finances consumption, while wealthy debt usually finances control of appreciating assets. This isn't just a theoretical distinction. It's playing out in real time. Mortgage debt has risen consistently as home prices hit record levels, and mortgages now make up the majority of all American consumer debt. The people who got into appreciating real estate years ago are riding rising valuations. The people locked out are watching the entry price climb further away. Meanwhile, on the other end of the spectrum, nearly half of Americans carrying credit card debt expect that balance to grow even further this year, and a striking number of people now believe they'll carry credit card debt for the rest of their lives. Two groups, two completely different relationships with borrowed money. One group's debt is quietly compounding their net worth. The other group's debt is quietly compounding against them. Same word, debt, describing two opposite financial forces. So how do you actually tell which side you're on? Ask 3 questions before taking on any debt. 1. What does this debt buy? An asset that can pay you back, or an experience item that's gone the moment you use it? 2. What's the realistic return versus the interest rate? If you're borrowing at 19% to fund something with no expected return, the math is working against you from day one. If you're borrowing at a low rate to acquire something historically appreciating faster than that rate, the math can work in your favor, but it isn't guaranteed, and that distinction matters. 3. What happens if I can only make minimum payments? If the honest answer is, I'd be paying this off for over a decade, that's not financing a purchase. That's signing up for a long-term, low-grade drain on every future paycheck. None of this means debt is something to fear categorically. It means debt is a tool, and tools amplify whatever hand is holding them. The same leverage that builds a real estate portfolio can just as easily sink a household that uses it for the wrong things. Here's the uncomfortable truth. Financial education rarely teaches this distinction clearly, and the businesses extending consumer credit have very little incentive to teach it to you either. More than 2 in 5 Americans now believe they'll carry credit card debt for life, not because they're incapable, but because nobody handed them a framework for telling productive debt apart from consumption debt before the balance built up. Wealth isn't built by avoiding debt entirely, and it isn't built by drowning in it either. It's built by knowing, line by line, which category every dollar you owe falls into. If this is the first time you've heard debt explained this way, not as good or bad, but as a tool that depends entirely on what it's pointed at, that gap in financial education is exactly why this channel exists. Hit subscribe, because next week I'm breaking down exactly how the wealthy use one specific strategy, borrowing against assets instead of selling them, to grow their net worth without paying a cent in capital gains tax. You don't want to miss that one. Drop a comment below. Are you currently carrying debt that's building your future or draining it? Be honest. I read every comment, and it shapes what I cover next. See you in the next one.